Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. Me, Ryan Huang, with markets kicking off the week in familiar territory, grappling with yet another White House tariff cliffhanger. So equity futures are trying to figure out where to go from here as President Trump kicks the can down the road on his 50% tariff attack against the EU, shifting the detonator from June the 1st to July the 9th. And in the week ahead, we've got some data to watch out for, FOMC minutes, as well as the PCE readings from the US. Helping us to navigate what's to come, we've got Mitul Kotecha. He is the head of Asia FX and rates strategy for Barclays. Mitul, good morning. How are you doing today?
Good morning. I'm good, thank you.
Awesome. Let's take a look at how things are kicking off the week with markets. And this is yet another U-turn on tariffs from the Trump camp. So he initially said he would be slapping 50% tariffs on the European Union for what he sees as indifference towards getting a trade deal done. Then you had a phone call on Sunday. It seemed to go well, and that hike paused until July the 9th. So that kind of gives breathing room for markets right now. What do you take away from all this?
Oh, look, I think you can see this partly as a negotiating tactic, and clearly the call, as you mentioned on Sunday, seems to have brought the discussions back to the table. I think on the US side, it was reportedly frustrations with the lack of progress with discussions with Europe that prompted President Trump to highlight the potential for earlier tariffs and more aggressive tariffs. And again, now it looks like that's been delayed. But it shows that the market focus, which had shifted from tariffs to fiscal concerns, can't necessarily just ignore tariffs. It's still lurking in the background. We still have July the 9th as the key date, and there's still a lot of discussions going on in the background between the US and a number of countries. And so I think this news on, will they, won't they on European tariffs is just part testament to that.
Yeah, talking about the fiscal concerns, we have, of course, a lot of concern around the bill that just passed in the House, where House Speaker Mike Johnson has held the passage of the big, beautiful bill as the largest cut in spending in at least 30 years. But there are a lot of concerns around the federal deficit. How much do markets believe him when he says, no, this is not going to be a big problem?
Well, look, clearly the long end of the U.S. Treasury yield curve has been selling off, right? So there is clearly some concerns about the fiscal implications of this bill, whether it's the concerns on fiscal foreign buying or just, again, term premium being built in, market fiscal worries are accelerating. And this has been forecast to increase the U.S. deficit by over $3 trillion in over a 10-year period. So it's certainly not a small amount. Obviously, the White House is saying that there'll be enough revenues coming in and stronger growth to compensate, and of course tariff revenues, which there's some truth to. But clearly, the market is not yet convinced. You've got the 30-year Treasury yield now above 5%. Clearly, that sends some alarm bells to investors. And at a time when the deficit is rising, having rising debt costs is clearly going to be a concern for markets.
All right, let's take a look at how this is playing out in the markets, and it has put some pressure on the US dollar. We are heading into the FOMC minutes being reviewed. What do you see playing out for the greenback in the coming weeks?
Our view has been generally that a lot of the dollar selling has been now played out. Clearly, fiscal worries, normally a steeper curve, shouldn't necessarily inflict this sort of damage on the dollar. But yet, as we've seen, dollar index is now pushing further below the 100 level. It does look like, at least in the near term, we will see continued, at least near-term pressure. But our view is generally the case that, it's oversold. The sentiment positioning is extremely weak on the dollar now. And, we kind of prefer, carry trades and relative value trades in this environment where there's so much uncertainty around the overall dollar path. There's a number of reasons why we think the dollar perhaps has already weakened too much. So we would suggest that perhaps relative value or carry trades are the best way forward for FX markets, given this uncertainty.
Okay, so talking about carry trade, which crosses are you looking at more closely now?
Well, look, I think there's definitely an interest back in some emerging markets carry trades. We've actually got a basket trade of some higher yielding currencies versus low yielding currencies, which span a number of currencies overall. But there's no doubt that investors are looking at perhaps a little bit less volatility, higher carry in some of these sort of EM currencies, which are clearly going to probably see some more upside here. One other currency pair which we think is perhaps got a bit more scope as well is a short euro yen, and that's one we've sort of undertaken in our major FX currency pairs.
All right, talking about some of the assets benefiting from a lower dollar. We've got gold doing quite well in recent months, even years. Right now, if you look at where gold is up a pretty amount. I believe we are looking at more than 30% year to date. So that's where we are looking at gold at $3,335 an ounce. If you're talking about gold, or rather US dollar, or the selling's been done, where does it leave gold right now?
Look, I think gold is benefiting from a number of reasons, right? Whether it's de-dollarization expectations or concerns, whether it's safe haven demand or inflation worries, it's seen to continue to have that sort of upside bias. Now, we've seen gold struggle to break above $3,400, but nonetheless, it's in the recent weeks, it's seen some renewed upward momentum. And as you said, very, very strong momentum in the last several months. And again, for all of the reasons just mentioned, it just seems like gold remains fairly well supported in this environment. But historically, in an environment where U.S. yields are moving higher, you would expect gold to perhaps be a bit more restrained. But again, we are in a different global environment. Concerns about tariffs, concerns about inflation, concerns about the U.S. exceptionalism and U.S. economy are probably reasons why gold has done so well. So it's very difficult to see how gold can come off strongly from these sort of levels here and probably looks well supported.
Yeah, talking about a different environment, we are also seeing Bitcoin doing quite well, year to date up 17%. Now, typically we see stock markets do well and Bitcoin doing well, but now it seems like a bit of a divergence here. Is this speaking to you in some form about where risk appetite is right now, or how Bitcoin could be an alternative of sorts when it comes to value?
Overall risk appetite has recovered quite well. If you look at what happened, obviously notwithstanding the end of last week, but generally, U.S. equities have recovered a lot of their lost ground that we've seen in the last, since Liberation Day. We've seen all of that lost ground pretty much recovered. And, I think investors have been quite, focused on the fact that at least on the risk appetite side, things have improved quite significantly. Now, of course, there's a number of deadlines. Tariff deadline will be important. We'll be watching the hard data on the U.S. economy. The dollar gyrations will be very important in this respect. But for now, it does look like we've seen a fairly decent improvement. Now, I guess the concern is that our risk appetite or risk assets now priced to perfection is a lot in the price here, and that is something investors are focusing on.
All right, taking a look at the data ahead, you alluded to this earlier. So we've got a couple of things playing out, FOMC minutes. You have also the core PCE index. Central banks also going to be in action. What are your main concerns in the coming days?
I think generally, when we look at the Fed, what we probably will see is still some caution. I mean, the Fed clearly has been hesitant to sound dovish here. They're worried about inflation being sticky. They haven't yet seen the weakness in the hard data to potentially show that the economy is coming much weaker from here. The tariff truce, and certainly between US and China, and the pause with other countries for the 90 days has helped to restore some growth expectations. So I think, generally central banks are cautiously easing. We think, for example, the Fed will only cut once this year in December and then 3 times next year. So at this point in time, with inflation perhaps still a little bit more sticky, we're looking at sort of the hard data. We're looking at how inflation pans out in the weeks and months ahead. And for now, it seems like central banks still cautious easing is the way we're looking at this.
All right. Great snapshot of the week ahead. And we've been in conversation with Mitul Kotecha. He is the head of Asia FX and Rate Strategy for Barclays. Mitul, thanks for your time and have a great week ahead.
Thank you.
All right. Catch up again soon. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.